The interest rate that we have today remains appropriate for the conditions that we see, even though it didn't say that in the press release. But the analysis that goes with that suggests that there is emerging there some downside risk to the outlook for inflation. And that's what all that talk was about. So, I'm not saying that the door is not open to an interest rate cut, but obviously it is. It is open. But it hinges on how the data evolve from here, because our base case, we have a strong belief that this will prove temporary, but temporary could be longer or shorter. And to the extent that it's longer, that opens up a larger output gap, puts more downward pressure on inflation, and we would have to come back to that decision and decide then whether or not the interest rate as it is today remains appropriate. We considered whether we should be looking at an insurance rate cut in October. In what sense would it be insurance? Well, that would be insurance against a downside risk that, coming from the outside, which we knew was washing up on our shores. And the question was, well, how big of an effect would it be? Phase one. And secondly, if it were of a magnitude, would it be big enough to offset the other side of that risk equation, which is, well, you would be maybe pouring some fuel onto financial vulnerabilities, making an even hotter housing market, and that could make it harder for us to reach our inflation target down the road. So that's October. Now, come forward to now, some of those downside risks have clearly landed and they've crystallized. So we were like, okay, now we're assessing how big they actually are and whether they will continue to get bigger or last longer than we're supposing. So in that context, the sense of whether we need an easing in monetary conditions is obviously present in the analysis. But the trade-offs are not as simple as it sounds in that mechanical way.